Hi, my name is Spencer Carenti. I'm with Alkaline Advisors, and tonight we are going to go through our premium commercial development financial model template. So buckle up, hoping this takes between 20 to 25 minutes. The goal is to thoroughly explain the functionality of the model, how to use it, and just provide broad strokes as to why we built it out the way that we have. So with that, let's begin. And actually, before we begin, know that we can customize anything. So if you see something in the model that you want changed, or you like the model but you want something added, feel free to reach out and we're happy to help where we can. So now with that, let's jump in. The model has a cover page, and then you'll see we've got a lot of tabs thereafter. Not too many, but a fair amount. The blue tabs are what we call input tabs, and the other tabs will auto-populate their output tabs. So within the input tabs, you'll see we have blue cells. This is what's called a fully dynamic financial model, meaning that all you have to do is plug the information into the blue cells, and all the other cells will populate automatically. And to show you, you can see we have project test 123, and we have OGOOS LLC. So if we go to the cover page, for instance, you'll see OGOOS LLC is up here. Test 123 is down here. You can throw a nice picture in of your project. If we were to change this to project name, let's say Apple 123 and LLC, let's say U LLC, you'll see that you are now in the top right and Apple 123 is the project. So going back to the inputs page, I would say 90% of the inputs are on this tab specifically. And we try to really section it off so it's very easy to not only understand, but it's easy to walk someone else through at a very high level. So you'll see we have broad categories where we have the black headers, and then underneath we have those subcategories. So we'll start with general information. Pretty self-explanatory. We'll then move to project timing. You can choose when the analysis start date is, when we're inevitably selling the asset, and all of these figures will auto-populate based on other assumptions and inputs in the model. And by the way, this is a 15-year monthly DCF, discounted cash flow model. Let's drop down to the valuation section. Simply put, we can showcase the value at stabilization and at sale of the asset. So we can choose what net operating income, what NOI are we taking to value the asset given a cap rate at that point of valuation. So stabilization will occur based on other inputs, as we'll get into in a second. And then the sale will occur in month 120. So let's use a sale as example. You can then say at the time of sale at month 120, are we taking the trailing 12 months NOI, the forward 12 months NOI, or the trailing 3 months NOI, and then annualizing that in order to derive the NOI at which we're using to value the asset. So we take that NOI and divide it by our cap rate to get the value of the asset at the point of sale. Then we have some selling costs associated with the sale that'll factor in. Underneath, we have the operating inputs. I would say half the operating inputs are here, half are in the rent roll, which we'll get into in a moment as well. But essentially, you can see we have other income and expenses. The other income and expenses are structured similarly. You can choose, and by the way, this is reimbursable expenses. Then we have a non-reimbursable expense section as well, which we'll get into in a second. But for the other income section, you can choose how we're identifying the other income. Are we tying it to the total rentable square feet or only the occupied rentable square feet? What are we growing the other income at what percent per year? And then what is the income type? So are we taking a total amount per year of the other income? Say we think we'll have $200,000 per year of TBD, or are we saying we're going to have $200 per rentable square foot per year of TBD other income? So right now we're at 150,000 per year, but if we make this 200, for instance, and toggle this to RSF per year, now it'll flow through $200 per rentable square foot per year. And you can see how that impacts the bottom line up here. So you'll see we can showcase, and this is, by the way, GP level returns, LP level returns, general partner, limited partner, and the partnership returns. And this is the project level return. So this is the property level returns. Unlevered meaning no debt, assuming no debt, and then levered meaning assuming the debt that you will put in your inputs. So for instance, if we made that 200 RSF, you'll see that's a $209 million profit. And by the way, these are phantom numbers. That would be a great profit. And if we did total dollars, now that drops to 24 million. So quite the difference. So let's make this 150,000. Then we'll jump to the rent growth and loss section. We have market rent growth, we have vacancy loss, and then other rent loss, just so you can factor in some growth and loss. And again, we'll get into the specific nuances of the individual lease agreements of each tenant. Expenses are going to operate very similarly to other income. And again, these are phantom numbers. They're not real numbers. They're just for show for this walkthrough. Non-reimbursable expenses, again, situated similarly to the expense section. Then we have replacement reserves. You can choose, are we doing dollar per rentable square foot per year or total per year? And then what does that look like? And then we have taxes. Taxes are done pretty uniquely here. We've given you two options to analyze taxes. The first is hard-coded inputs, where you can literally drop in the actual amount that you'll pay in years 1 through 5, and then in year 6 plus, you'll just apply a growth rate to year 5. The other way we have done this is by toggling goal seek taxes. So this model has no macros. This model has no circular references. Essentially, what we're doing here is we're saying that the post-construction basis is going to be 15.3 million. Also known as the project costs are going to be 15.3 million, essentially. The stabilized value of the asset in month 28, because that's when stabilization occurs, and that all auto-populates, that'll be $23 million at that 5.5 cap, which we've assigned up here. And then at sale in month 120, it's going to, the value of the asset's going to be let's call it $44 million, right? And that is based on this 5 cap. It'll be $44 million. What we're saying is that we're going to take 1.1% of the values. Now, ordinarily, this would be circular because the property taxes are an expense, right? A property level expense. And when you change the property taxes, that changes the expense, which changes the NOI, which in turn changes the value of the asset. So what we're saying is to derive the expense, we need the value, but then to derive the value, we need the expense. So again, that's iterative and we don't have circular references. So what we do to get around this is we have goal seek. We use what's called goal seek functionality. So I'll quickly show you some of the stopgaps we have in place to help you understand how to goal seek this correctly. So let's say instead of month 120, we want to sell this asset in month 100. So month 100 takes place after the refinance, which we'll get into in a second. But now you'll see we have some red popping up and some instructions. That's good. That means that this isn't accurate as is. We need to do something about it. So what we can do is we can goal seek this. We can go to the ribbon bar. We go to data, what if analysis, and goal seek. So we click that data button. We click this what if analysis, and then we click goal seek. So it shows us instructions, right? Step 1, right? Let's do tackle in order A, B, and C. Set cell field should be set to the red cell on the left. So in this scenario, we want to set this to set cell. Step B, the to value field should be set to 0. So let's make this 0. By changing cell, the by changing cell field should be set to this on the left, by changing cell this. So now we'll click OK. And what's going to happen is it's going to iterate, and essentially it's going to give us this new number of the value, given the fact that we are taking 1.1% of the value of the asset at sale for the taxes. So we're happy to dive into that further. Maybe we'll do a subsequent video just really dialing in on the goal seek functionality, but I think this is sufficient for now. Let's go back to hard-coded. Then we have the operating reserve section. The operating reserve section is a really neat tool that we built out. Essentially, what we're doing is we are let me take a step back before I keep going. Because you're building this out, this asset out, you can factor in the TIs and LCs, the tenant improvements and leasing commissions, to the upfront cost of the project for at least the first generation, the first tenants, tenant improvements and leasing commissions that you'll need to pay. However, in subsequent tenants that you'll have, you'll need to pay for those tenant improvements out of pocket. So what we're going to do is we're going to build up an operating reserve, which will cover the TIs and LCs and any operating shortfalls we might have at a project level. So ideally what happens is we have surplus NOI, free cash flow, and we'll be able to allocate that surplus NOI to pay down any shortfalls in a given period. But if there's shortfalls in a given period, like let's say tenant improvements, and we don't have enough free cash flow to cover that, we're going to have to pull from the operating reserves, which we're going to be building up steadily until we have those shortfalls. So the way that we are identifying how we're building out the operating reserves is by this toggle. We can either say that we're going to pay all the shortfalls with equity, and if that's the case, we're not building out the operating reserves. We're just, every time there's a shortfall, we're going to come out of pocket. Or what we're going to say is we're going to build out the operating reserves based on either the sweeping some operating cash flows, sweeping the refi, or sweeping both the operating cash flows and the refi. So if we were just sweeping the refi, we're going to sweep 0% of the operating cash flows, right? And we're going to sweep, let's say, we want to sweep 20% of each, but we're just sweeping the refi, so we're not going to sweep any of the operating cash flows. And the most that we need to sweep to cover that let's call this $1 million shortfall. Again, if we toggle this to equity, the shortfall is $1 million. So the most that we need to sweep is not 20%, it's only 14%. So we're not going to sweep more than we need, so to speak. Similarly, if we then, let's say we toggle this instead of refi to just the operating cash flows, you'll see the reserves do not cover the shortfall. We need an additional $875,000 of equity required. So even though you're sweeping 20% of just the operating cash flows, what's going to happen is we don't want to sweep the refi because we don't have refi toggled. What's going to happen is we're going to have to come out of pocket for $875,000, or we can maybe up this to 50%. Still not enough, because even if you sweep 50% of the operating cash flows up to refi, or actually up until your shortfall, you're not going to have enough to cover. So what we can do instead is toggle this to, instead of operating cash flows only or refi only, we can do operating cash flows and refi. So what we're saying is we'll allocate up to 50% of our operating cash flows and 20% of our refi. And turns out we only need to allocate 5% of the operating cash flows and 13% of the refi to cover all the operating shortfalls. And then we'll showcase what this looks like on the back end. And what we're saying is it's actually 50% of all operating cash flows up until we cover, which again, we'll showcase on the cash flow tab. So with that, that's the operating input section besides the lease up section, which is the rent roll section, which we'll get into now. So the way that we built up this rent roll section, essentially we have two different inputs fields on this rent roll section. We have the in-place rent roll, or you can think of this as first generation rent roll. And then we have the second generation rent roll thereafter. Also, you'll see we have third generation, fourth generation, fifth generation, and so on. But we have in place, and then you can consider this as maybe market. So again, the blue cells are the input cells. You'll title the suite name, or if you already have a tenant in, you can label it the tenant's name, whatever suite number it is, the size of the suite or the space. And in this column, we're typing in how many months of downtime are we going to have until that first tenant comes in. So if you recall, we said that we're stabilized in month 28 because everything is drawing from this column. If we then say that Suite 160 is going to lease up in month 30, and we go back to, let's say, the inputs tab, now you'll see stabilization occurs in month 30. So again, everything's tied together. You can then choose the lease term in months. You can choose the rent per square foot per year for all of these tenants, and then it'll calculate the rent per square foot per month. You can choose the escalation frequency. So when are we growing the leases? Every 12 months, every 36 months, every 60 months. And then we have the annual growth rate thereafter. So this is the first escalation, and then this is the escalation thereafter. We then have free rent. Is there any free rent that the tenant will be receiving? What are the tenant improvements per square foot? What are the leasing commissions? And then if you recall on that inputs tab, we had the expenses broken out by reimbursable and non-reimbursable. So we actually are tying out the recoveries to the reimbursable expense section. So you can choose how we're recovering the expenses per tenant. Are they triple net? Is it a base year? If it's base year, you choose that 2020, or it'll show 2026 and what that base year total is given the square footage. Again, is it triple net or is it gross? If it's triple net, you can assign what percent of the expenses are you recovering. So you can assume 100, or maybe there's some leakage and you can assume 95, whatever you'd like. Then going down, we have the second generation or market. So you can choose what the retention ratio between tenants is. And this is a probability. So you could say there's 100% probability that they're going to resign. There's an 80%, but then these assumptions are used in the future tenant roles. So again, you have the downtime, lease term, current market rent per square foot per year. And this is today, and this will grow at whatever the annual growth rate is. This will grow up through whenever the lease transitions from first generation to second generation. So you don't have to recalculate these figures, so to speak. New free rent versus renewed free rent, if there's a difference. New TIs versus renewal TIs, because you might have different TIs for different groups. And because of the probability, we're taking a percentage of this versus a percentage of this. Same thing with leasing commissions and then the recoveries. And then underneath, we've got more cash flows for first generation, market, free rent, leasing commissions, so on and so forth. Let's jump back to the inputs tab now. And we'll now move down to the financing input section. So this is the capital stack section. We've built out the capital stack on this development project to have a construction loan, to have pref equity. It could also be considered mezzanine debt, and then to have LP equity and GP equity. So those are the four slugs in the capital stack. Additionally, we have a refi section, which you can refinance the construction loan and the pref equity / mezz debt. So to start, the construction loan is derived based off of the project cost. So if you come down here to the budget input section, you'll see we've broken out 6 pads, 5 of which can be used for inputs, and then 1 of which we recommend not inputting because we have this tied to the custom cash flow tab, which we'll get into in a second. But essentially, you load in the inputs. You can choose whether these costs are financeable or non-financeable, because if they're not financeable, then the lender won't factor that into what they're providing a loan to cost on. If they are financeable, then the lender will factor that in as to what they're providing debt on for that loan to cost, right? Non-financeable, essentially, you're paying all that with equity. So you can see we have the total project cost of $16.8 million. Again, phantom numbers, of which 5.3 are not financeable and 10.9 is financeable. And that's pre-interest reserves. 11.5 is financeable with the interest reserve. So again, this model is not circular and doesn't have macros. We're actually calculating the interest reserve based on a goal seek here as well. If you want to say that the total loan to cost with interest reserve is 65%, we would do that same goal seek functionality by making this 65% by changing this essentially. So additional functionality we have in here is, and by the way, this is interest that is compounding. So as you probably are well aware, when you're developing an asset, during the development period, you're not able to pay off the interest most of the time because you don't have any cash flow. So what's happening is the lender's still generating the interest on whatever debt they've provided to date based off of your draw schedule. But that interest is not being paid current. So that interest is accruing and then compounding. So it's essentially being applied to the principal, and then that principal is generating more interest on it, which has the interest. So essentially the interest is generating interest. Again, we'll show you this on the cash flow tab in more detail. But you can choose your loan fee, and then you can choose whether or not, once you do have free cash flow at a project level, whether or not you're allocating that free cash flow to pay down what would be the accruing interest. And if you can, then it wouldn't be accruing anymore if you can pay all that interest down. And if you can't, then you're just paying down whatever you can, and the leftover balance is still accruing. So let's then work our way to the pref equity / mezz debt section. If you don't have any pref equity or mezz debt, easy enough, toggle this to no. If you do, we can load in the inputs. You can choose the dollar amount you have. You can choose what upfront fees or exit fees are associated with this, and you can choose a percentage of that for the upfront fees and the exit fees. For the upfront fees, you can choose if those upfront fees are paid current to the investor or if they're accruing. And then you can choose what interest rate is being paid in current pay, meaning that regardless if the cash flow is available, you have to pay that. So you might have to come out of pocket, or accrued interest rate, or both. So you can have a current interest payment and an accrued interest payment together. Then you can choose what percent of the free cash flow you have is being swept to pay down this pref equity amount. The idea is you want to pay this down as quickly as possible, pay it off as quickly as possible. So you're going to choose 100%, but you can make this anything you'd like if you want to give some of your LP investors, or if you want some cash flow at a project level. Then we also have the ability to choose what the minimum equity multiple is. So let's say that there is no minimum equity multiple, or there's a 1.2 minimum equity multiple, for instance. No, that wouldn't work. We would need, the project has a 1.14 in this section. So let's say there's a 1.1 minimum equity multiple. Because we're hitting that 1.14, we don't need any additional payoff to hit this minimum equity multiple. If we have 1.2, for instance, then you'll see you'll need an additional $55,000 at payoff. Payoff occurs in month 32. All of this updates automatically. First draw is month 17, right? All of it updates automatically. And you'll see that the investor has that 1.2 equity multiple. So now moving up to the perm loan section, maybe you don't have a perm loan, maybe you do, right? Maybe you're a merchant builder, you're building and selling, great. What you can do is you can toggle this to no. But say you toggle this to yes and you want to refi, we have some pretty cool functionality in here. So essentially you can choose what your loan to value is of the refi, but you can also size the loan given some sizing parameters. And what we've done is we built out three sizing parameters: loan to value, minimum debt service coverage ratio, and then minimum debt yield. So assuming that there's a refi, assuming that there's 65% loan to value, the way in which we derive the value of the asset at refi, we're saying that we're refinancing in month 32. It's telling us that we're stabilized in month 28. So for instance, if we wanted to refi in month 27, we'll get an error, right? Because we're before that. Also, we have no revenues in month 27 in this model, so the model explodes. But assuming we refi in month 32, let's say that we want to value the asset at month 32 using the cap rate methodology, using in-place NOI at a 5.5 cap. What we can do is use trailing 3 NOI or forward 12 NOI. Again, if we're refining at month 32, that shouldn't matter that much. But let's say we refi at month 29. And remember, we don't have, and let's see, we're going to use a trailing 3. We only have revenues at this point, or tenants in place at this point in month 28 and 29. So it's literally 2/3 of the value of the asset, because we're taking the trailing 3 NOI, if that makes sense. And we only have NOI for 2 of those 3 months, and annualizing it out, that means we have NOI for 9 of the 12 months. So with that in mind, our value is significantly lower than it should be. And you can see that the refi does not cover the construction loan. by 1.5 million. So there's actually a safeguard in place for you. But let's actually move this to in place again, and let's make this month 32. Great. We can actually choose how we're valuing the asset. We can say it's going to be based off of cap rate at that cap, or if we do dollar per square foot, you can choose what the value is based off of X dollar per square foot. And that is just another way of potentially valuing the asset if you want to see it a little differently at refi. You can choose the interest rate, the amortization period, and then any interest only period, and also any loan fee. Now, for the sizing functionality, right now we're saying, given the fact that we're refining in month 32, we want 65% loan to value. Well, we can get 65% loan to value, okay? Now, if we were to say our minimum DSCR threshold is 1.2, enter, you'll see that that arrow that was up here dropped down, showing that the DSCR refi is now 1.2, which is good. That's what we need it to be. But that arrow is no longer up at the LTV, and the LTV is now a yellow color. So given that threshold, that minimum DSCR threshold, we can't secure a 65% LTV. Realistically, we can secure a 60% LTV. Now, bear with me. I know I said this was going to be 25 minutes. We're at minute 27, but the inputs tab is going to be the longest run through, and then everything else should be cake. So that's the perm loan section. We have the same thing with debt yield. So if we want a 10 debt yield, you'll see that drops again. Now our DSCR is 1.31 given that 10% debt yield. So let's move this to 5 and let's move this to 1.1 so we can get the full 65%. Great. The last two sections of this inputs tab are relatively straightforward. We have the sensitivities, which we'll talk about in a second, and then the SOFR. The SOFR is pretty unique because the SOFR curve allows us to paste in from Chatham Financial the forecasted SOFR curve. That'll pull through the model, but it also allows us to track the historicals. So after the historical is available in the next month, this will showcase blue, and then you'll have to manually update it. Old data will drag through, and if it does and you don't delete it, then it won't tell you to update the SOFR curve, and it'll essentially just use the old information. But if you do want to add the most up-to-date, you can zero this out, and it'll remind you, update SOFR curve. So this is applicable when you have a construction loan that is tied to SOFR. So here you can choose between fixed or floating. If it's fixed, it's just a fixed rate. If it's floating, you have how many points above SOFR, what's your floor, what's your ceiling. So now let's talk about this sensitivity analysis section. This is some really cool functionality as well, and you'll see this is good. We want to see this red because that means that it's not accurate right now. And what we can do is we can update it so that it is accurate. So what we can toggle between sensitivity, this is a 2-variable sensitivity analysis. Essentially, we're sensitizing the exit cap and we're sensitizing the sale month. So right now we're saying we are, let's actually make this 120 for the time being. We're saying that we're going to lose that red drop down right here. So we're saying that we're assuming we're going to sell the asset in month 120 and we're assuming we're going to sell it at a 5 cap. But what if we sell it in month 114 at a 4.5 cap, or month 126 at a 5.5 cap, or really anything in between? That's what the sensitivity is allowing us to do. It's essentially iterating all of those scenarios and showing us what in this scenario, in this case, the levered IRR would be at those different scenarios. What's cool about this sensitivity analysis is we can actually toggle to see what the sensitivity would look like for not just the levered IRR, but the profit, the equity multiple, and the IRR at a project level, at a GP level, and at an LP level. So right now we're at levered IRR. Let's say we want to see the levered profit. What happens? It zeroes out. Note, if return cell is red, update data table, go to formulas, calculate now. So this is a user error that pops up to showcase that this as is isn't right. So we want to go to formulas, calculate now, click that button, give it a second to iterate, and boom. The red goes away, the yellow goes away. This is what the levered profit would look like if sensitized. And you could do the same thing for IRR, equity multiple, project level, GP level, LP level. All right, now we're going to move a little quicker through this. The goal is to get it done in 40 minutes or less. I know I misspoke initially, but here we are. So next, we are going to go to the cash flow tab. Let me zoom out. So the cash flow tab, again, we've got monthly cash flows. Everything is aligned nice and neat between construction costs on the top, operating statement underneath. Then we have the capital stack underneath, which we have the partnership equity, the pref equity, if there is any, you can hide it. The construction loan, again, showing all of the rates, which you can hide if you don't want to see that. And then the operational reserve section, the sales section. Underneath that, we like to break it out into inflows and outflows. I always say that modeling is really three things. It's contributions, it's distributions, and it's timing, right? How much are you spending? Contributions. How much are you receiving? Distributions. And timing. When does that happen? When does all that take place? So we try to break it out into contributions. So the initial contributions, what does that mean at a project level in terms of cost? Operating shortfall. So what additional costs are there that aren't part of the actual construction cost, so to speak? So any operational shortfall, we consider that a contribution as well. And then distributions, we've broken it out into two sections. Distributions from operations, so that's your free cash flow any given month. And then distributions at a capital event. So that would be at refinance or at disposition or the sale of the asset. And then everything boils down into the net cash flow section. Unlevered cash flows and levered cash flows. Unlevered is assuming no debt. Levered is assuming debt. And this levered cash flow line will go into our partnership return section, which I'll get into later. Okay, so now the only inputs in this model are actually, or sorry, on this tab are actually in this construction cost section. So if you open this up, you can see that we have the costs outlined here, and you can choose the start month and the end month of the cost, and then how it's allocated. Is it straight lined or is it customed? And is it bell curve? And the bell curve, you can toggle between straight line, small bell curve, large bell curve, or custom, and the custom ties to the custom cash flow, which we'll get into a second. But here they're straight lined, so it all flows accordingly. Okay. You'll see in the first generation TIs and LCs, we have custom, and you'll see they all hit in this one period just because, as we said, all the spaces are going online in month 28. So we say that we're going to charge, we're going to incur these costs 1 month prior to when the spaces actually come online. So if we were to go to the custom cash flow tab, you'll see we've built out a custom formula that ties to the rent roll based on whenever the TIs and LCs flow through, just for the first generation. But all these other options, if you do toggle custom instead of bell curve, if custom is toggled, the name of the cost will update here automatically. This will showcase green, and then you can allocate the costs automatically until they're fully spent, and then you'll see that the allocation will, so right now, for instance, let's say it says that we need to allocate 487,000. We can make this 487,000. Now it says we need to allocate 500. Let's make this 500, for instance. So what we would do is we would make this 500, and now it's all green and done and allocated. So that's how the custom cash flow tab works. Going back to the cash flow tab, again, those were really the only inputs on that tab. And with that, we're now going to jump to the annual cash flow, which is just a consolidated version of the monthly cash flow, but this is all annualized. And you can see some other metrics and assumptions and snapshots that we have built out over here based on untrended versus trended at stabilization and then sale. And then we have the partnership returns. This is a really cool tab because this takes the project level returns with debt, and it then allows us to distribute between GP and LP given the waterfall structure. So you can choose what percent of the equity the GP is providing versus the LP. You can choose the compounding frequency of the preferred interest to the LP. Is it compounding annually, monthly? Is it not compounding? You can choose a distribution frequency to the LP. Is it distributing monthly, annually, quarterly? And then equity. Are we contributing the equity all upfront, or are we contributing the equity when it's needed on an as needed basis? So right now it says incurred, so you can see the equity is all contributed when it's needed. But if we raise all the money up front, you'll see all of that goes to the front. And then that'll actually bring down our IRR because of the time value of money. Essentially what's being said now is we need to give that preferred return not just on the money when we need it, but on the money all upfront times 0. So for instance, if you look at our GP IRR, when we're collecting upfront, it's 32%. And if we then toggle to incurred, we're at 40%. We can also choose hurdles. How many hurdles do we have? We can choose no hurdles. We can choose 2 hurdles, 1 hurdle. We can choose 3 hurdles. And essentially, you can choose what the hurdle amount is for the IRR for the LP. So we're saying that every dollar coming in is going to be split 90-10, LP to GP, up until the LP receives 12% IRR. And then from 12% IRR to 14% IRR, every dollar that comes in, there's going to be a 20% promote going straight to the GP, which means that the 80% of the cash flow remaining will then be split 90-10 LP GP. And then from 14%, and that's why we have the promote of 20% to the GP, but the actual distributions is 28% to the GP, 72% to the LP. And then from 12 to 14, we have 20% promote. 14 to 18, we have 30% promote. And then 18 plus, we have 40% promote. So this is the partnership return section. And then all of that information flows up nice and neatly into a digestible snapshot that we call the investor summary. So this is the investor summary. If you print it out, I don't know if you'll be able to see this, but you can print it out into a 3-page PDF. It's all nice and neat that you can print and send around. But you can see you've got you LLC up here, the project here, everything auto-populates. We have the investment description. You have investment returns and metrics, distributions and contributions and total profit, IRR, equity, multiple, ROI, not just at the GP or LP level, but at the pref equity level, at the project level, assuming no debt, and at the project level, assuming debt. Then we have snapshots at different times. So we have a snapshot at stabilization, a snapshot at refi, and a snapshot at sale. This has different metrics and values and so on and so forth. But you'll see NOI capture at stabilization. We said we wanted in-place NOI. At refi, we wanted in-place NOI. At sale, we wanted trailing 3, right? At stabilization and refi, we wanted to use a 5.5 cap. At sale, we said 5. Probably won't actually be the case, but you can update accordingly and it'll all flow through. And if you toggle no to refi, this says no and everything zeroes out. Then we have some basic text. This text auto-populates. You can see it's formulaic based on the inputs and assumptions. The sources and uses will update automatically based on the inputs and the assumptions, right? You can see additional inputs and info over here if you want. The charts and the graphs update automatically. Same thing, we have notes on the construction loan and the perm loan. These auto-populate. The sensitivity is mirrored over here from the inputs tab. Operational reserve notes are here. That auto-populates. You have info on the operating statement, the operating statement chart. This pulls automatically. Again, you'll see we said that there's a 60-month lease term for all of those tenants, and there's different probabilities that they remain online. So we have downtime of a certain amount given the fact that it's probabilistic, and you can see how that impacts the revenues and the expenses. In place versus market rent, you can toggle what you want to see. If you have rent per year, rent per month. We have a snapshot at stabilization versus of the operations, a snapshot at stabilization versus a snapshot at sale. Again, in place versus trailing 3. That'll update automatically when you toggle it on your own. All right, 42 minutes. We'll be done by 45 minutes. I'll tell you that much. Then underneath, you have the annual summary, consolidated version of the annual cash flow summary down on the tab over here. And then you have your draw schedule. So the draw schedule is pulling from the capital stack. You can see everything here. And then finally, you have the perm loan, sale value, contributions, distributions. And then if you'd like, you can see the partnership split. So this is the GPLP section. You can see annualized what that looks like from a waterfall perspective. And the last tab we have is the lender summary. So it's similar to the investor summary, but more so catered towards the lender, a little more simplified. And then all this auto-populates is from the lender's perspective. Same thing, investment description. And then the property snapshot, you have information at a property level, and then refi snapshot, just in case you want to show the lender what the refi looks like. Maybe the construction lender wants to stay in the deal, and you can showcase that there. But all this auto-populates as well. And then finally, we have a disclaimer tab. So with that, 43 minutes, pretty solid. A long rundown. What I'll do is I'll create a table of contents in the video so you can actually go to it and click in the different sections so you don't have to bore yourself watching this whole video. Or maybe watch it in double speed and then it'll take 21 minutes, right? So with that, really appreciate your time. Again, if you have any questions, please feel free to reach out. We're always available. We're constantly updating models, making new models, making custom models. We work on fund models. We work on portfolio analysis, multifamily, commercial, mixed use, you name it. And we'd love the opportunity to work with you and help you out. So if you have any questions, please reach out. Again, my name is Spencer Krente. I'm with Alkaline Advisors, and I hope you find this video tutorial helpful. Have a great night.